Welcome to the Gender and Access to Finance virtual course. This is part of the Gender Responsive Economic Policy Management in the context of COVID-19 pandemic courses. And this is our 8th course in a series of courses. We have already covered 7 courses, and we are left with 2. So let me speak very briefly in this presentation about the Gender and Access to Finance course and what it entails. For details, I think you can look a little bit more at the narrative. The narrative of this course does provide you with sufficient detail that you can look at, but also to read some of the publications that we do recommend that you look at. Now, to start off, Module 8 on Gender and Access to Finance will provide an overview. It provides an overview on the role of finance in development from a gender perspective, as well as laying the for what we can call the conceptual foundations that permit an examination of microfinance as one of the main strategic tools used in Africa for promoting poverty reduction and gender equality. The module introduces the theoretical, institutional, and policy frameworks for financial sector in Africa, and then the idea and practice of microfinance in particular, highlighting the consensus as well as the contestations around its potential to reduce poverty and empower women. The expected outcomes: one is participants are introduced to the theoretical, institutional, and policy frameworks for the financial sector. Also, as participants, you will also understand the evolution of microfinance. We'll speak, and also we hope that at the end you will identify and probably discuss the dimensions, gender dimensions of finance and microfinance and some of the major policy implications. And then we'll also develop some kind of gender-aware approach to finance and microfinance in particular. Now, on gender and microfinance, one of the things I would like to speak to before I go deeper is the whole question of finance and economics. As you all know, finance is a branch of economics that studies the management of money and other financial assets that can be bought, sold, lent, or borrowed through financial markets and institutions. Now, the set of institutions that facilitate the buying and selling and lending or borrowing of money and other financial assets is known as the financial system. Now, in theory, the buying and selling of financial assets should follow the laws of demand and supply elaborated in module number 1 on gender economics. But in practice, we know that supply and demand explain the buying and selling of financial assets, but the explanation for the supply and demand of financial assets is complicated by the intricacies that are there of financial assets and how they are created in the financial system. And we shall elaborate this briefly, because much of the buying and selling of financial assets in modern financial systems is of assets that have not yet been produced. So you have assets that have not yet been produced, and they are the ones you actually are dealing in, or which the seller does not own, but which other seller lends in exchange for payment. And more generally, savers are individuals or institutions that supply money in form of deposits to a financial institution, and then the saver does in return for an income flow in the form of interest payments on the savings from the financial institution. Now, the financial institution then goes ahead and uses money that savers deposit as a basis for advancing credit, which is the transfer of an amount of money from the lender in the financial system to a borrower inside or outside the financial system. So I can see this is how the financial system works a little bit differently from how demand and supply works. Now, if you have to think about a loan, to obtain a loan, a borrower usually must provide collateral and it's transferred to the lender in the event of default. So you could have like a title deed for a piece of land, which is one of the things which I used a lot here in different parts of Africa. Now, in obtaining the credit, the borrower acquires a debt that must be repaid in full. In addition, the lender charges a price for the loan. The rate of interest or the amount of money that the borrower must repay above that which was borrowed is what we call the interest. Now, the financial institutions make money by lending money to borrowers at a higher rate of interest than what they pay to savers who deposit their savings in the financial institution. So financial profits does a redistribution of resources away from the borrower and toward the lender. So the financial system therefore involves a cycle of saving, depositing, lending, borrowing, buying and selling, with the financial institution acting as the intermediary between those that save and those that borrow. Now, when we talk about, let's talk a little bit about the women's access to financial markets in services in Africa. Now, rural women in Africa are known, and this is what some of your research actually says, have higher saving rates, not higher saving volumes, but higher saving rates than men. However, they have, in a sense, not low, while they have higher saving rates than men, they have lower cash incomes and do not meet most of the legal requirements in the bank. I know that some people find that controversial because they ask the question that if they have very little resources, how come they have higher saving rates? But I think it's important to make a distinction between the saving rate and the saving volume. And for women, what is known in research is that they have higher saving rates. Actually, it's a very interesting paper I found from Pakistan that I posted on our training that you can have a look at. Women end up holding their savings mostly in non-cash assets or cash or informal financial institutions. And gender inequalities in property rights and biases in the financial sector also do shut women out of accommodative monetary policy, like increase in formal lending. Women money lenders still do provide a common informal financial institution, which includes exchange of relationships beyond financial markets, like market for labor, market for land, and many other things of that nature. But the point we are making here is that critical points that first, women have higher saving rates, and that has been observed in many parts of Africa, although they don't have all the legal requirements required to be part of the formal financial institutions. And because of gender inequalities, we also see that these create biases because women don't have property rights as much as men do. And that means that they get shut out of the financial sector. Now, what do we see as some of the approaches to microfinance across Africa? Well, microfinance is actually rooted in the assumption that access to microfinance is key to poverty reduction and economic empowerment, and that microfinance recipients will invest mainly in income generating activity. Operational approaches include traditional group-based systems and specialized lending by NGOs, cooperatives, and rural banks. And microfinance institutions operating outside the banking sector have to find their own source of funds, and this is support is usually through things like local cooperatives, local clubs, village associations, which are very, very central to mobilizing savings. Now, the lending approaches include things like lending, poverty lending, which is usually subsidized by donors and characterized by people working together in groups. But also the financial system approach is mostly commercial oriented, and it focuses on what has been controversially described as the active poor. Now, women have been disadvantaged in formal credit, and women are also targeted in different ways by the microfinance institutions. Loans to women have continued to be small and have continued to target economically active women, and this leaves most of those who are in need without any loans, and this in itself can reinforce gender biases in the financial sector, including disregard for the amount of care work that is involved for any person that is linked to. Now, poverty lending still has to contend with the reality of gender inequalities at the household level, including the role of men. And microfinance institutions also make the assumption that when you reach the group, you reach the poor. And those who cannot join the groups are sometimes left out. There's actually an interesting paper which I may post called "Find the Groups and You Have Found the Poor." It's a critique that was done here in Uganda, a study of how using groups for poverty reduction and what that means. Now, women also have higher rates of repayment in parts of Africa. This has been proved 90%, but yet this also can reinforce a bias towards women, with the focus being on repayment rather than the impact of funds. So actually what attracts some of the institutions is this higher rate of repayment. But sometimes if repayment is done and does not translate into impact, like the money does not create impact, but it is paid back, that in itself is a complication. Women have higher rates of repayment, and as I've said, and organizational structures of microfinance institutions are also, we know, heavily led by men, nearly 70% in management, with 90% of their clients as women. As you can see, there are a number of gender biases that are rooted in this dynamic. On one hand, you see that nearly 90% of the women, the rate of repayment owed by women is at 90%. But we have not yet established what is the rate and the impact of the funds that come out of that very high repayment rate. On the other hand, the institutions themselves of microfinance are still very much dominated by men in management, and that in itself is a challenge because you have 70% men and 90% women. That can create other types of biases. While it is not to say that these men may not know or not be sensitive to women's issues, but it is an issue to also look at in terms of how many women are actually in the management of microfinance institutions that lend to women. Now, some of the debates on microfinance and women empowerment, there are several, but let me summarize them into a cluster of three, which are like the major debates around this, and then the debates which are on the positive side and those on the negative side. On the positive side, The argument being made is that microfinance have an effective in terms of creating an effective coping mechanism for the poor women and men. That yes, when you have this money in small amounts being given out, does actually create a coping mechanism. The other positive that is also mentioned in different studies is that women access positively affects nutrition, health, and schooling of children. That women's access to microfinance does positively affect things like nutrition, like health, like schooling of children, because indeed the women do invest in these areas. And also that microfinance increases the skills of recipients, like business management. They develop skills in planning, record keeping, and many other areas. So those are some of the major positives. In terms of negatives, some of the key ones that have been mentioned is that one, microfinance itself has failed to reach the extreme poor and tend to focus those who are not poor or near poverty. And this is the concept of the active poor. It seems to suggest that there is a type of people there who can actually be the ones to be targeted, because these people, have got a certain level of income and ability to pay. There is little evidence of the economic gains from microfinance, as we said before. For example, even while we have 90% repayment rates for microfinance loans, the impact of those funds is still challenged in terms of actually showing empirical evidence of a very strong improvement in the welfare of those that fall. And microfinance is also known to deal with, is not known to deal with some of the systemic gender barriers, and sometimes it does reinforce inequality. As we saw in the positive aspects of microfinance, is that sometimes when women have these resources, they could be investing more in care related investments. And in that sense, you are not in any way shifting the dynamic at a household level between women and men, but actually you are keeping that dynamic intact because the gender division of labor gives women more roles in care. If that's where they're investing, that's where they are putting all their energy. So this is one of the sort of negatives in terms of the debates around microfinance and women's empowerment. So, ladies and gentlemen, this was really to give you a very broad brush and introduction to the whole question of gender and microfinance. There is more in the narrative to this module that you can look at. But once again, thank you very much for listening to me, and I'll see you in the next module when we talk about gender and budgeting. So thank you very much.